Hi, everyone. I'm Rick Bensignor. Today is Tuesday, March 22nd. Welcome to this week's In the Know Trader Show. As we record late Tuesday morning, S&P futures are flying once again. They are up just over 50 points, as well the cash market, the S&P itself, up 51. That's 1.15%. The Qs are up over 2%. And the Dow is up about 70 basis points or so. Big news again today, interest rates on the move. They're up 7 basis points to 2.38% in the US 10-year. Crude oil down about $2. Natural gas up 16 cents. Bitcoin up about $1,600 at just shy of $43,000. And gold taking it on the chin a bit today, down $18. So what do we have on tap for today? In our trader education portion, we're going to talk about, and this is in pure market terms, about being a warrior, not a hero. In our market overview, we'll take a look at those aforementioned Qs, the US 10-year via the TNX, and Kathy Woods' ARK fund, ARKK. And we're going to, as you can see, we're going to focus on the tech sector this week. We haven't gone into the individual names in a while, and they're certainly on the move. And the question is, was the bottom from last week the bottom, or just a bottom with another one at some point to come later this year? Well, we'll try to figure that out, and we'll go through these, 15 names or so that we've got here, which are the, we actually have, there's a mistake here. This is not CAN. This should be ACN, Accenture, not whatever CAN might be. So we'll go through these names and hopefully give you some sense on how to play these names. To sign up for the weekly In the Know Trader Tactical Trader Report, generally comes out Thursdays. Go to our website. Now, we do know there's a problem with the website. I've been working diligently with the folks at GoDaddy. We're actually have built a whole new website. We are hoping that within by next Monday, it will be up and running. So you can access or access the website. Right now, it's telling you that there is no, what's that thing called? The security, SSL or something like that. I can't remember. But you can still get to the website by just saying, it's okay, I still want to go to the website. Nonetheless, you have the options there to sign up for the weekly tactical trader report or the 7-Eleven monthly spider sector ETF report. That's the goal of that monthly report is to get you into the right sectors at the right time in the S&P. There are 11 macro sectors like materials, energy, financials, communications, consumer discretionary, etc. 11 different tickers starting with XL that go through those 11 sectors, and combined in the right percentages, they equal the same thing as the return of the spider. What we try to do is keep you in no more than 7 of the 11 sector ETFs at any one time, with the goal of outperforming the S&P by avoiding the underperformers as best as we can guesstimate at the start of each month. We use both quantitative, technical, and market timing information. And in the month of February, for instance, we outperformed by 82 basis points. Since our fiscal year began, which is last August, we're up 2.22% versus the S&P. And since we started 19 months ago, we are up a whopping 5.67% over the S&P. That would put us in the top 10% of all money managers out there. And instead of managing your money, we tell you what to do, so that you make the very minimal allocation changes. Once in a while, we pull out a sector, it's not too often, and substitute it. So it's a really easy way of having a much better chance of doing better than the market itself. And of course, my email, rick@intheknowtrader.com. We appreciate all the feedback that we get from you. All right, let's take a look at these 11 sectors versus the S&P itself year to date. On the far left side here, the S&P down 6.15% coming into today. Best performer, obviously, and the only sector that is up on the year is energy. It's up 38% and change. So it is up, it is outperforming by some 44%. That's 4,400 basis points just this year alone. Worst sector, communication services down about 13%, consumer discretionary down about 12, tech down about 11, everything else down. The best ones of the ones that are down though are still outperformers: industrials, materials, staples, healthcare, utilities, and financials. Real estate also underperforming, down 9%. This is something that you should be watching all the time to have a sense of which sectors to be in. And some of these are short-term moves, some are longer. So for instance, we've been overweight technology since we started going all the way back to August of 2020. We've moderated how much at any given time we may be overweight, but it is a sector that we believe in long-term and still believe in. And energy is something that last August we went into a full double weight relative to its ranking in the S&P, and that is what has given us tremendous returns. So this is something you should be doing yourself. StockCharts.com plots this very easily. If you go into the perf charts and pick the S&P macro ETFs, and just go into the lower right-hand corner where it chooses how much time it shows you, right-click and do year-to-date, and you'll get something that looks like this, and just very handy of why you want to be in some of the sectors you are at any given time. For instance, if you're seeing consumer discretionary and communication service and tech getting hit hard all year relative to the S&P, then even though, yeah, it's bounced since we bottomed last week, there are other sectors that were better placed to be in that you didn't get hurt as badly and or you just made money on. So it really pays to keep attention to what the sectors are doing, so it helps you figure out where to make your plays in and which sectors to avoid continually trying to buy, let's say in what was a down market up until a week ago. All right, now let's go to this week's education topic, which is about being a warrior when it comes to playing the markets as compared to being the hero. So let's take a look here. The left side are kind of ways I think of what it's like to be a warrior, and the right side really more towards the hero side. And let's take a look at these, because you'll see that although there are times in life it's very nice to be a hero, it usually almost always does not pay to be the hero in the market when you're playing. So let's take a look. What do warriors do? They fight a good fight. Each day they come in prepared, they do their homework, they play, and their goal is to make money as frequently as they can and to hopefully make even more than the S&P would make, because if you're consistently making less than the S&P makes, you might as well just be in SPDRs or be in the 7-Eleven report. Do something that makes you money and you don't have to work real hard for it. So a good market warrior fights the good fight. They may get injured, meaning they may take some losses, but they recoup because they understand money management and they don't let any string of losses knock them out of the game. Warriors come home to his or her family, meaning that you're never so badly hurt or knocked out of the game that you can't come back home to regroup and then lead to the next bullet point, prepare to fight the next battle, right? So you may be injured, but you're still the person coming home. And that's of course metaphorical, but in a way of meaning like you're not dead and out of the game. And you come back and you prep for the next day's battle, and you keep an eye on the long-term game plan. What's the long-term game plan when you're an investor or a trader? It's to make sure that you're always able to come back and play another day. So that's how I kind of look at warriors and why you want to focus that way and make sure you understand money management and you control what your losses are and you don't get stubborn, and you make sure that a string of losses or one huge one doesn't knock you out. And you never want to put tens of thousands of dollars, well, of course it depends on what size portfolio you have, but you never want to kind of bet the house on an idea, because if you're right, and we'll talk about this in a second, you want to be the hero who picked the exact bottom and held on for years and made a killing. But that's not usually, when you bet the house, you also have a very good chance of losing your house. And you never want to lose that foundation of what keeps you and quote your family together, the roof over your head. So as you're a warrior and you fight the fight, you keep an eye on that long-term game plan to make sure, and that long-term game plan, long-term survivability, always be there to come back to play another day. Don't let any single or string of losses knock you out. Now look, let's compare that to those who come in with the hero complex. They play the fight, but they try to play the fight to stand out from other people, to be able to say, I bought the low, I sold the high, and anything that could happen like in between that. But in other words, these are people who do bet the house. They like betting big and trying to be right. And it's fine. Occasionally you are. But so many times, look, I have some friends I know of who have 50% of their net worth in the crypto land. And I just can't believe it. It's to me nuts. And there are, as of recent statistics, because of the pullback from all-time highs down into, the now low 40s, and recently we were in the upper 30s range, there are more people with losing positions on in crypto land, in Bitcoin terms, than there are winners. And to bet that much on the belief of something that is still so unproven, that is a pure gamble, that the fundamentals are so difficult to actually assess correctly, is just, to me, foolish. And yes, maybe it all works out, and maybe this goes to over 100,000 and 200,000 per coin, or whatever it might be, but it also could go to $5,000 a coin. You just don't know. And there's no value behind what you're trading. You're buying into this whole thought process that people did years ago, and now you're playing along, hoping that it's really the greater fool theory, that somebody will pay higher than you do who's bought into this story after you have. Well, to me, that's not where I'm going to invest for long-term survivability and to ensure that myself and my family are protected and have money down the line. So the thing about heroes is they often can't recoup. Imagine if the negative scenario plays out, you've got 50% of your assets in crypto, and we'll use Bitcoin as the example here, and Bitcoin goes to $5,000 and your average price long is $40,000. Can you really survive when you have that much of your assets into one name? You can't afford to not be able to recoup from something, and heroes who have the hero complex often can't recoup. They'll do whatever it takes to win, and that's often what makes them a hero, but they do it regardless of the cost. And there are no accolades in this industry. If you bought the low and sold the high in stock XYZ, you can pat yourself on the back, and maybe your closest friend and your spouse may do the same, but that's it. Nobody else cares. This is about you and your personal finances. So be careful about doing something, regardless of the cost. I'm going to stay with this name regardless of how much I lose because I'm confident it's going to come back. Well, that's just not the right frame of mind to have long-term success in the market. And because of that, you may or may not come back to your family at some point. In other words, and again, this is all metaphorical, you may not survive the battle. And I've known people, especially, the early part of my trading career was on the floor of the commodities exchange. I spent 12 years trading in the pits. And the guy who brought me into the industry blew out in April, I think it was April of 1987 in the silver market. And he was so sure silver was going to go down, and he was short, and he had big size on for a kind of an individual, what they call a local, somebody just trading their own account. And he blew out, and he was just gone from the industry, and lost everything. You don't always get to come back when you try to be the hero. And it means that you're often not around to see the long-term game plan play out, because you've thrown the whole idea of a long-term game plan out because you've bet so big on one thing, trying to be the hero, trying to be the one who says, you know, I sold the high before it fell apart. You know, it's just, to me, the wrong way to approach playing the markets. So be a warrior, play that, you know, fight that good fight, but make sure you come back to play another day. That's my thoughts on that. Let's get to some charts. We'll start with the diamonds. That's, of course, the Dow Jones ETF tracking, you know, similar to the SPYs, but just for the Dow. Let's see, here's my cursor, nice big arrow. So we've bounced off of holding support. We're back up through the top of the cloud, gradually just nudging last Friday, and where we are currently is above the weekly baseline. If the highest high and lowest low of the move was made within the last 26 price bars, which, you know, the baseline looks back 26 bars, finds the highest high, the lowest low, adds them up and divides by 2. So it's the arithmetic midpoint. So you know that the level of 346.09, which is the value of the orange, the baseline right now, the orange line, that is the 50% correction from the lowest low to the highest high that we've seen. So if that was all-time highs back there in the first week of January into the low, this made the spike low on the markets generally. I think February 24th was the day of the low. This has now moved up. So it's held basically, you had one Friday close beneath the TD/ST line, this dotted line. We held for all practical purposes against last May's lows, and we've recovered. The question is there enough, and let's blow this up a little bit, is there enough to think that that's all we're going to do, and this turns around and goes back and makes new all-time highs, which a lot of people are thinking? And to me, the answer is no. I'm not making the bet that we just simply, I'll make the bet and have that the lows are in near term, but I'm not making the bet that the highs stay the highs. And even if we made new highs, that they would be new highs that lasted any bit of time. I think because think about it, the S&P ran at 5% last week off of Tuesday's open and low. The things that had been pressuring the market are still quite at hand with no improvement. So when we think about the macro headwinds to the market, the Russia-Ukraine war is in no better situation for it being resolved than it was a week ago. Interest rates are actually substantially higher than they were a week ago. And the higher interest rates certainly can affect earnings down the road, along with the inflation being what it is on 40-year highs. That hasn't changed. It's not going to change for a while until the Fed can, and if they can, control inflation. So between the erosion of the value of a dollar because of inflation and the effect of higher interest rates on corporate profits, other than perhaps in the financial space, it's hard to make the case that this just simply goes and makes new highs. So I'm thinking that generally I'm selling into some of this rally to lighten up at the very worst here. So let's, at the very worst, we're kind of exactly where we were in a year ago. Last March, here's let's see, sorry, that's May. So let's call it 10 months ago, where the market was 10 months ago. So it's not so bad that if I light up here, I'm kind of right in the middle. The average price over the last 10 months didn't sell better than it, not selling lower than it, right? Mid price. It's if you think that because the Fed is now hawkish and not dovish, and we know they will continuously be hawkish for quite some time going forward, the biggest single ingredient to why the market moved up as much as it has since the 2009 bottom was the Fed was an easy Fed that continuously pumped money into the marketplace. And all that free, easy money that cost people virtually nothing, businesses nothing, was able to translate it into much higher prices in stocks. Now, the economy is doing well, very well, but these are still serious headwinds. So at the very least, you don't expect the type annual returns that you've seen in the past. And it's not, to me, a crazy idea to say, I'll use this rally to lighten up some exposure. That's the way I'm thinking about things. Let's take a look at the US 10-year. And we've got, we can look either, let's look at the weekly instead of the daily. So this is rocking to the upside. You can see right now we're at 2.377%. The inverted head and shoulders pattern, I've drawn two different necklines, either the red line or the dash blue line. Either one of them you could have used as necklines. Either way, we've broken well through it. We pulled back close to them and shot up. Use traditional technical analysis, take the lowest low, find where that was to the necklines at the time, figure that out in percentage terms, add it to the breakout area, and what it does is measure up to 3.25%, which just happens to be the last high that the market made before it dove to all-time lows. So that's the target. Bigger term, 3.25 is the target. In the meantime, we've already passed through 2.16%, my initial 2022 estimate. Next, we have 2.5 to 2.6% or so. Some other targets up here. But you've got a Fed chairman who could not be more opposite than, let's say, Alan Greenspan of some, I don't know, what, 15, 20 years ago or so, who double talked a heck of a lot, but wouldn't really tell you anything. This Fed chairman is as open as can be in getting the message across of what he's thinking and which way he's leaning the Fed to move. Even as recently as before yesterday's comments, a week earlier, when he was testifying in front of a Senate panel, and he said, I'm going to support a 25 basis point increase in the next meeting. You never had a Fed chair do something like that and basically tell us. And now yesterday he said, you know, we may need to increase rates at a faster pace. And that's why rates are screaming to the upside. And you're seeing a flattening of the yield curve because, let's say, the 2-year is moving up quicker even than the 10-year is. So you're getting a flattening of the yield curve, and you have a Fed chairman who's telling you what he's going to be doing. It's incredible and great for investors because he's taking the shocks out of the system. But you don't want to fight the Fed. And when you see, you know, interest rates just leaping forward like this from a Fed chairman telling you that this is what the Fed's going to be doing, you can play, you can lean against targets and stuff, but you basically want to lean towards the direction of higher rates. And we've been saying for it's over a year that, you know, the lows back here were the lows. And I told you on this sell-off here that I had sold out of almost my entire bond portfolio that I personally held, and hedged the rest. So, you know, this is the move now. We know the bigger picture move measures up to 3.25%. Let's look at XLK. So here's technology. This off, let's put a cloud chart up. So not only did we have a triple bottom in the Qs, well, XLK, sorry, but the lagging line held against this baseline. Just more reason there was support there. Now, if we look at the weekly XLK, it's different than the Qs because it was a weaker market than the diamonds. And you'll see that, you know, we're not near the 50% correction yet. It's still a few points away. So expect some resistance there. And then against this double high, if we get into the mid 160s, and that's kind of where you broke down from too. So that's, yes, we came and we bottomed where we needed to hold. We've come back, but I have no reason to just assume that we're going to turn around and scream to the upside. By the way, I just put in the sequential stuff. So we also see the weekly 9 with an 8 bottom. So it was perfected and it's come back up. So the all-time high was marked by the upside exhaustion signal, and the corrective move down also found, you know, cloud support from the actual cloud, lagging line against the baseline, and the 9 count, enough that got us and you know, clients of in the no trader clients were warned of the daily 13 signals that came in last Tuesday morning in the S&P and the Qs, and that's why, you know, we think the market screamed to the upside. Surprisingly, although this happens sometimes, we're out of time for the week before we even got to go through all the individual names, the key names in the tech sector. So we will do those next week. I promise you we will get to them. And hopefully you got some value out of what I talked about as far as being a warrior, but not a hero when it comes to playing the markets. That's it for this week. I'm Rick Bensignor. Hope you enjoyed the show. This is In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.